A green candle always opens on the bottom and closes on the top. That means if this is a 1 minute chart, after 1 minute, the candle was going higher, and then you see the time the 1 minute is finished. Then again, the green candle opens on the bottom as you see here again, and after 1 minute it was going higher and it closes at the top again. The wick is just the highest point or the lowest point of a candle, but it all comes down to the candlestick body that you exactly know. If this is 9:40 a.m., that 9:40 started here and 9:41 ended here where my mouse is. The red candle opens on the top and closes on the bottom. That means after 1 minute you see 9:41 started here and 9:42 is here. Again, 9:42 opens here now, did you understand? And 9:43 is starting here. 9:43 is starting here down here. And 9:44 is ending here. So now you understood how candles work, how they move up and down with the green and the red candle. Watch this again until this section if you didn't understood it. And that you understand how powerful color switches are. If there is a green candle, it shows us the market was going up. A red candle, that the market was going down. Now check this out. If you can see again that the market does a green candle and a red candle and goes lower again and referenced them before. And again, a green candle and a red candle, it goes lower. This is absolute cool. This is how to read a trend, that if you see that the market, make it always small as possible. You don't need actually to read candles that much, but it would be useful for you to use it in your trading. The first step at all is always, if you're on the computer or if you trade with your phone, whatever device it is, can you see that the market does lower highs in case what we just identified? A high is always a green and a red candle. Or does it do higher lows? A higher low is always a red and a green candle. And here you see again a red and a green candle. And the reason for this is because if you see the market structure does higher lows, and we make only money in trading when we buy and the market goes up. If we buy and the market goes down, we would lose money. What is bad? It's also okay in some ways if it's according to the trading strategy and to our experience. But of course, you want to make sure we want to make money. So when we buy, for example, we buy in any specific price because we assume that the market will go higher again because it did before. If the market does higher lows, as you see here, a low is always a red and a green candle. And it shows us that the market was pressuring down and then it was going up within 1 minute. To expect then that the market will do again down and up is very high, because when you can see that the market, this is something what's very important. If you can see the market does, maybe it's 2 or 3 green candles within going higher. And then you see maybe 1 or 2 candles that the market goes lower. And then you see again 2 or 3 green candles, like you see the length of going up is more longer, then that the market comes back and does those retracements that I'm drawing in here. If that's the case, then now we can measure within X amount of candles. So it doesn't matter if from here to there, these are 5 candles, 10 or 15 candles. If we can see from starting here to up here, this was maybe 10 minutes or 15 minutes. I'm going to show this to you how you can identify this in the chart. Then of course, we're going to expect actually that the market in the next 10-15 minutes will also go up within the same length. Makes sense, right? Because you see the market goes up within a certain time, very fresh, and then we assume that the market goes up too. Now here's the thing, in trading it works like this. You have always like these CFDs, like you have leverage 1 to 50, 1 to 20, 30, 1 to 1,500, 1 to 500, whatever. If you trade on the futures market, you have the broker, and the broker tells you if you want to trade at this market with your position size 1, it will cost you $400 margin, it's called around. And then it depends on the broker. And then you need also to have your trading capital. That means if this is, for example, the market that is called the S&P 500 futures, and the minimum price fluctuation in Forex, they call this pip, but we call this here in futures ticks. Each minimum price fluctuation the market goes up, it's with one position size $12.50, and I would need to have $400 on the account and my trading capital. So if it's a $2,000 account. I have $1,600 to trade, and I have $400 for margin to trade one position size. If I see now here's a small green candle and I'm entering the trade here, where my X is. Each time the market goes up, if I buy here, if the market goes up, I make $12.50. If the market goes down, I lose $12.50 each price fluctuation the market goes down, and it's called tick. And there is something that is called the stop placement. The stop placement tells me if the market goes down, I need to sell to go out of my trading position. Because if I buy, it's like you buy, you're at 1. And then if it goes up, you make money. If it goes down, you would lose money. But to realize our winning trade or losing trade, we would need to sell. So we would need to go from 1 to 0. That means if we buy, for example, and the market goes up, for example, like 1, 2, 3 times up here. Now we take a calculator and $12.50 times 3 means it's $37.5. The market would go up here. If I would sell here, if I would be able to get here out in the market exactly here, I would have made $37.50. If the market goes down here, for example, 2 times down, it's $12.50 times 2. It's $25. That means I would lose money and I would exit by selling. So it is about like you buy in a certain, you see that the market goes up. Please use always a demo account, that's not a real money account. When you expect the market goes up and you buy and the market goes more up, we make money. But in the same length the market goes down, we lose also the same amount of money. And this is why to have a stop placement, this is something what's very important. And then you can play with something that is called the risk reward ratio. If, for example, this is a $3,000 account, I can say now, instead of adjusting here, maybe 1, 2, 3, 4. If those are 4, for example, so 1, 2, 3, 4 down, this would be $50. And I'm telling myself, like, if I can see that the market goes up like this, and every time the market did a higher low, I'm not assuming that the market will go lower than these lows here. If I can adjust a stop placement that if I buy, that I tell my trading platform and my broker, I only want to use minus $100 maximum. This is what I want to use. If the market goes up, then I'm telling myself endless. Whatever makes sense to me. Like if I saw that the market did this move within 5, 15, 20 minutes using the 1 minute chart, and I'm expecting the market will do the same move again. In this case, it would be, let's check this out together, how much it would be. We have then 1, from here it's 0, and then it's 1, 2, 3, 4, 5, 6, 7, 8. So that would be 8 times $12.50. And then in this case, 8 times $12.50. We would have here $100, and this is just for one position size, okay? For one position size. So because it goes 1, 2, 3, 4 down, like 4 times $12.50, it means this one would be only $50 actually of loss. But as I just said, when adjusting it now to $100, I'm not taking one position size. I would take 2 position size that I'm risking here. That means like what I want to use maximum is to use $100 for this trade, expecting that the market goes up. And then to take, and this is very important because here we calculated here that it's $100, the winning trade. In this case, it would be $200. In this case, it would be $200 then. I'm going to show this to you now on the chart, that you understand it so good as possible. That means, for example, here, if we can see the market goes down, and we have this small reference of a red candle, and this is something what I really love, how to use a small stop placement in trading. The red candle opens on the top. The red candle closes on the bottom. The entry point is so near as possible here. On the right side, there's usually a timer that counts down from 1 minute, and then it will show you where 1 minute is is it says like 10, 9, 8. It counts down and it shows you when the 1 minute chart is finishing, like the candle is finishing. Entering the trade here and the stop placement up there. And how much money to adjust depends on the, if I say, for example, I take from a $3,000 account, $1,000 divided into 10 trades, then that's what I'm going to take and adjust here. And the interesting thing is now we have the risk reward ratio. If I'm adjusting here $100, if I understood that, look to the right side, it says 75, 00, 25, 50. It says here 1, 2, 3, 4. Like it says here 4 price fluctuations. If I can see here that it's 4 price fluctuations, then the advantage is here literally that when adjusting here $100, it will be down here where you can see the marker. It says 4.8. It says it would be 4.8 times the amount of what I was setting here as I wanted to use for this trade. So if I say I want to use here $100 for the trade and I'm adjusting that, as I just explained, this would be $500 around, like $480 trading down here. What is absolutely cool. So now can we adjust exactly $100 for each trade? The answer is no, we cannot. But we can adjust if it's $80 or $112 around, or if it's like $50. Like you have these position size step in this case. And this is how to have a small stop placement. Hope you can take something out of this. Wish you all love, good trades. JT out.